In the mid-1990s, the financial world was in awe of a new hedge fund called Long-Term Capital Management, or LTCM. Based in Greenwich, Connecticut, it was led by John Meriwether, a former star trader at Salomon Brothers. But the real draw wasn't just him, it was the board of directors, which included two Nobel Prize-winning economists, Myron Scholes and Robert Merton. They weren't just picking stocks, they were using complex mathematical models to exploit tiny price differences in global markets. The strategy was called convergence trading. Think of it like this: if two similar bonds were priced slightly differently, the models assumed they would eventually converge to the same price. LTCM would bet massive amounts of money that this would happen. Because these price gaps were tiny, they used incredible amounts of leverage, borrowing up to $25 for every single dollar of their own capital to turn small margins into massive profits. For the first few years, the math worked perfectly. Between 1994 and 1997, LTCM returned nearly 40% annually to its investors. It was the golden child of the hedge fund industry. Banks were practically begging to lend them money, and investors were fighting to get their capital into the fund. To everyone watching, it looked like they had discovered a way to print money without any real risk. But in 1998, the environment changed. The Russian government suddenly defaulted on its debt, sending shockwaves through global markets. Investors panicked and fled to the safest assets they could find, like US Treasury bonds. This caused prices to move in ways that the LTCM models had never predicted. Instead of converging, the price gaps between the assets they held grew wider and wider. The models were based on historical data, which assumed that market panics would be rare and short-lived. But this wasn't a normal day. Because LTCM was so heavily leveraged, these small, unlikely price movements started eating into their capital at an alarming rate. Within a single month, the fund lost nearly $2 billion. The Nobel laureates were watching their perfect strategy collapse in real time. By September 1998, LTCM was effectively insolvent. They were on the wrong side of thousands of derivative contracts, with virtually every major bank on Wall Street. If LTCM were allowed to collapse, the ripple effect would have been catastrophic. Because so many banks were tied to their positions, a bankruptcy could have triggered a domino effect, freezing global credit markets and potentially causing a systemic financial failure. The Federal Reserve, led by Alan Greenspan, realized that this wasn't just one firm's problem anymore. They stepped in to orchestrate a private bailout. 14 major banks were brought to the table and forced to put up $3.6 billion to save the fund and unwind its positions in an orderly way. It was a massive wake-up call for the entire global financial community. Ultimately, the story of LTCM is a story about the limits of human intelligence and the dangers of excessive leverage. The fund's downfall proved that mathematical models, no matter how sophisticated or decorated with Nobel Prizes, are only as good as the assumptions they are built on. When you bet your entire firm on the belief that markets will always act rationally, you leave no room for the unexpected. The lesson here is simple: complexity is not the same as safety. Even the brightest minds in history can be humbled by the black swan events, those rare, unpredictable occurrences that models simply cannot account for. In the world of finance, the more leveraged you are, the less room you have for error. When that margin of safety vanishes, even geniuses are forced to face the harsh reality of the market.